once you've done all this stuff, cleaned out your debt, have a budget, established some savings, change your spending habits, you know, you're probably going to want to purchase a home. You know, you're going to want to start a family. If not, you still, I mean, purchasing a home is not terrible. Even for a single person, you know, that's something within your range that you can afford. It's a good way to save money as well, because you're paying yourself rent because you have this loan. You took out this money. All you're doing is paying back the money for the property. And once you have that property, you own it. And once you own it, that property has value. Now, some people, you know, they get into real estate as far as like a job. They want to make money quick. Bam. Like I said, purchasing a home is an investment in yourself. So you want to start saving now. That's why you go through all this budgeting. You want to save now to purchase a home. Before you even have good credit, before you even know how much you want to spend on the house, you want to start saving now. And after that, you want to get your credit together. Once you've got all that together, budget, savings, a healthier credit, because you don't have to have a great credit score. What you want to do is you want to show them that you have good credit habits. So you want to pay on time. You want to have too much debt. You don't want to. What you want to do, you want to shop lenders for pre-approval. The bank that you're with now can probably have some kind of online process, or go into a branch and let them know that, hey, I want to know what I can be pre-approved for. They can tell you, hey, you can only afford an $80,000 home at, you know, this much, blah, blah, blah. And you can know what your target now. You know, if you want to make more money, whatever it may be, then that's up to you. Avoid adjustable rate mortgages. Even though you might pay the lowest interest rates this year, next year it might be the highest, and your payments will change. You know, you might pay $950, you might go to paying $1,300. You want a fixed rate mortgage, which the interest rate might be higher, but over the period or the life of the loan, your rates will remain constant. So, like I say, if you get a 20-year mortgage and you're paying $900, in the 15th year, you'll still be paying $900, and chances are your income probably would have increased by a bunch, but you'll still be paying $900. So you want to avoid a 30-year mortgage. It just adds too much interest. It's too much risk for a lender, that to think that, hey, you know, you start paying this at 35, you won't be 65 until you finish paying it off. So avoid a 30-year mortgage. If you can stomach a 15-year mortgage, do that. You know, you're 30 years old, 45, you'll have it paid off. Not a bad idea to go with a 15-year mortgage. The interest rates are usually lower because the risk is less. Like I say, your payments will be a little bit higher because you'll be financing the same amount of money in a shorter period of time. But like I said, the interest rates won't be as much over time. So, and plus your interest rate probably would be lower. So it's good to get a 15-year mortgage. You know, you might be paying only $200 more per month, but you'll be paying $30,000 less in finance charges. So you, like I said, you'll save a lot more money. You know, and if that's not feasible, 20 years not too bad. 20 years is a popular term. When it comes to saving, once you pre-approve, you want to have at least 10% of your down payment. If you can save 20% of the down payment on the home purchase price, I mean, that would be fantastic. So what it does is you avoid the mortgage insurance. So that lowers your payment. It also lowers your interest rate because you put so much money into it already. The home already has some value in collateral. If the home you're buying is $120,000, it's good to have, you know, $25,000 in cash ready to put on a down payment. You're going to still need some money for closing costs, you know, and some stuff like that. It's about another $5,000, but you can also put closing costs into the price of the home. So there's some different things that you can do. Like I said, it's also a complicated process, but, you know, these are some things that you want to have on your mind. 20% down payment is what I'm targeting. You know, I don't want to pay the mortgage insurance, and I already want to have some value invested in the home. Like I said, once you purchase the house, you have 20% down payment. You have 20% already in equity into that home. So, I mean, that's a lot of money, you know, to have, you know, that you can use for collateral or whatever. So go. So like I said, it's a very deep topic. I've already been talking 20 minutes about it. Like I said, just do what you have to do, and you can always Google it.